Dear professional students, you are welcome to another section. In this section, it is cost of capital and tax consideration we want to look into. Like the cost of capital we said cost of capital is WACC, you remember? Fine. And we also said tax is also part of those things that determine the level of cost of capital, the level of WACC. Now, one element to consider in deciding finance or in deciding to finance a capital project, fair equity or debt is the possibility of any tax savings. Possibility of any what? Of any tax savings from taking on debt, since the interest expenses can lower a firm's taxable income and thus its income tax liability. However, Modigliani and Miller theorem states that the market value of a company is independent of the way it finances itself and shows that under certain assumptions, the value of leverage versus non-leveraged firm are equal, in part because other costs offset any tax savings that come from increased debt financing. That is the claim. And and it also is also part of these professors, that is Modigliani and Miller, that if there is no tax, if there is no tax, debt financing does not have any impact on the value of the company. It is tax savings that make the interest expenses tax deductible, that make the issue of leverage has impact on the value of the market or the value of the company. If there is no tax, either debt or equity, both companies will have the same cost. That is on the tax and capital consideration. That is on the cost of capital and tax consideration. So the summary is that there must be possibility of tax savings. If there is no possibility of tax savings, the issue of using debt to finance business will be very, very too dangerous because of the interest payment. So it is the tax expenses that used to do what? It's the interest expenses that used to reduce the taxable income, and thus the income tax liability will also reduce once the interest has been removed from the profit made by the company. Now, under these subheadings, let's look at the difference between cost of capital and the discount rate. The cost of capital and discount rate are somewhat similar and are used interchangeably. Cost of capital are often calculated by a company's finance department and use the management to set the discount rate or the hurdle rate that must be beaten in order to justify an investment. So, a company management should challenge its internally generated cost of capital number, as it may be so conservative as to deter investment. Cost of capital may also differ based on the type of project or initiative. A highly innovative but risky initiative should carry a higher cost of capital than a project to update essential equipment or software with proven performance. So that is on that for this capital structure. I want to say thanks for stay tuned.